Doctors spent decades mastering medicine, yet most make a fundamental mistake with their retirement planning. And the crazy part is the same financial tools marketed as smart, like a traditional IRA, might actually be costing high-income physicians tens of thousands in missed opportunities. And when it comes to retirement planning, tax optimization should be your North Star. It's not about how much you save, it's about how much you keep after taxes. Now, here's the truth. Traditional IRAs often don't make sense for high earners because you're phased out of the tax deduction. For someone who has a 403b or 401k with their employer, you might start phasing out at $79,000 to $89,000. And if you're married filing jointly, then that phase out starts at $126,000. Married filing separately, then that is at $10,000, which means that, you're not going to benefit from this anyways. So if you're a high income earner, you're likely putting money into a traditional IRA with no deduction, no upfront benefit, and future tax obligations. So what is the point? And here's where things get interesting. The real value of a traditional IRA for physicians isn't for contributions at all. It's a stepping stone to something better, the Backdoor Roth IRA. If you don't know much about the Backdoor Roth IRA, I explain it all in this video. But here's the trap. It's called the pro rata rule. If you have any pre-tax IRA money, including a SEP IRA, a simple IRA, or a traditional IRA, the IRS forces you to pay taxes on part of any Roth conversion. So you don't get to convert just your after-tax dollars. You get taxed on the percentage of your total IRA balance that is also pre-tax. Instead of paying taxes on a few dollars of growth, you could get taxed on thousands, even double taxed in some cases. And this can completely derail your Roth strategy if you're not careful. But smart physicians like you, smart high income earners who are watching this video, they know to clear out any of those pre-tax IRA funds first before even thinking about the Backdoor Roth. Now let's walk through a real world scenario. A physician leaves their employer and they sit down with their financial advisor. The advisor suggests rolling over a old 401k into a traditional IRA. Why, you might ask? Because they can now manage that IRA and collect 1% asset under management fees on those assets. They'll say, this gives you more control over your investments. It sounds smart, but here's the danger. Rolling into a traditional IRA creates a large pre-tax balance, and that balance kills your ability to do a clean Backdoor Roth IRA conversion. And it's not just traditional IRAs. Open a SEP IRA for your private practice, you're going to have the same problem. A simple IRA, the same issue. And honestly, I have a personal story to tell. We opened up a SEP IRA for my husband's practice in order to put more money into a pre-tax account and reduce our taxable income. But that one move meant we couldn't do a Backdoor Roth, and we didn't realize it or think about it or make it a priority for years. And we lost out on thousands in tax-free compounded growth. So if you made this mistake, don't feel bad, but also don't delay it like we did. Let's fix it. And if you're a woman in healthcare and this is confusing you, well, don't stay overwhelmed. This is exactly why I am a financial coach, to help women to get financial clarity and build confidence without feeling the guilt like you should already know this and the avoidance that you can never understand this. And if you are looking to elevate your financial success in 2025, then click that link below and book a clarity call with me. Let's discuss your financial goals to see if my financial coaching is a right fit for you. I can't wait to see you on the call and help you reach your financial success. Now back to the video. Here are 3 options if you've got pre-tax IRA money. And the first is convert it all to a Roth IRA in a low income year and just pay the taxes. Let's rip off the Band-Aid and clean the slate. But then you will know that any future years, any future conversions, you won't have to worry about it at all. The second option is to leave it. But again, your future Roth conversions will be taxed proportionately under the pro rata rule. And The third is avoid it by rolling your old 401k into your current employer's 401k if they accept rollovers. Or you can roll it over into a solo 401k if you run your own business. These moves shield your backdoor Roth contributions from the pro rata rule. Here's the bottom line. Traditional IRAs were not designed for high-income professionals, especially those who have access to an employer-sponsored retirement account. Because you don't get the deduction. You expose yourself to the pro rata rule. You risk losing access to powerful Roth strategies. And let's be honest, most physicians aren't retiring into dramatically lower tax brackets. You're likely maintaining your lifestyle and staying in the same or high tax bracket. So deferring taxes now only to pay them later. That's not a win. The truth is traditional IRAs are just tools. And sometimes they're the wrong tool for the job. If this opened your eyes, then I want you to hit that subscribe button. This channel is here to help high-income professionals to make smart money moves with less noise, more clarity, and no hidden agendas. Drop a comment if you've run into this situation before. And if you want to learn more about the pro rata rule and all of the numbers, then watch this Backdoor Roth IRA video where I explain everything. Oh, and if you have an old 401k and you want to know some of the other options and what to do with it, you can watch this video right here. And until next time, people, I want you to stay wealthy, stay joyful, and I'll see you in the next video. Bye-bye.